Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Rolls-Royce's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Rolls-Royce Holdings is a British aerospace and defense company that designs, manufactures, and distributes power systems for aviation and other industries. The company is headquartered in London, England, and was founded in 1904. It went public in 1990 and trades on the London Stock Exchange, the Pink Sheets, Mexican Bolsa, and Deutsche Börse. In 1884, Henry Royce started an engineering business. In 1906, Charles Rolls and Henry Royce created a separate business to sell cars. In the 1970s, the company filed bankruptcy and stopped making cars. BMW subsequently acquired the name and currently makes Rolls-Royce cars today. Let's now talk about Rolls-Royce Holdings. It is the world's second largest maker of aircraft engines after GE and the world's 16th largest defense contractor. 42% of its revenue is from civil aerospace, 22% from power systems, 28% from defense, and 8% from other. The last dividend they paid was in April 2020, and they suspended future dividends due to weak sales from COVID. A big positive for them is the British Prime Minister has vowed to make sure this company will be around for a long time. He said this to ease everyone's concerns after the rating agencies downgraded Rolls' debt ratings. Having government support is a huge advantage for a company. Rolls-Royce is an important part of the UK, mainly due to its iconic brand, also its long history, plus all the jobs it has supplied over the past 100 plus years. The company announced it is leading the transition to net zero carbon, and it plans to achieve this by 2050 at the latest. They said it will focus on its technological capabilities to enable the global economy to get to net zero carbon by 2050, which includes aviation, shipping, and power generation. Its contribution includes the development of all electric components for the aviation sector, also a hybrid electric propulsion system for aerospace. Not just Tesla and Amazon are getting involved in space exploration, so is Rolls-Royce. It is developing a propulsion system for a spacecraft. They also plan to have a floating space station where they can build and repair things in space. It's pretty exciting and wild stuff going on that can potentially lead to a much higher stock price. In this picture, they show how they plan to go from Earth to the Moon, then from the Moon to Mars. This will make it easier to go to Mars if they go to the Moon first and get everything prepared on the Moon as opposed to the longer commute from Earth to Mars. They even plan to set up a base on Mars, which just blows my mind thinking about it. In this picture, you can see a beam of light going from Mars to a location outside of the photograph. They're implying that they will go to other planets. This is a very lofty goal, but very exciting nevertheless. This picture mentions its technology will support commercial and defense programs in addition to the space domain, creating world-leading power and propulsion capability for multiple markets and operator needs. A lot of big things on this company's horizon, and if they can achieve even 1/4 of what they mention, you may make a 5x return on your investment, possibly more. One focus is on this high Mach propulsion system. A propulsion system is a machine that produces thrust to push an object forward. Mach is the ratio of the speed of an object to the speed of sound. To explain decay heat in layman's terms, when in space, gas stations are millions of miles away and there are no outlets to plug in your charger. You would need a device which is made with radioisotope power. This converts heat into electricity. These systems are reliable and last a very, very long time. If you send anything into space, it will run out of power at some point unless these radioisotopes are nearby. This will keep your structure in space longer, giving you the opportunity to explore more of the universe. They're also making microreactors, which are small enough to be transported by truck and can power and provide propulsion for spacecraft. It also provides power to things so you're able to commute and explore regions of the universe. Reactors are currently being used on Earth to generate electricity for commercial use. All of these devices rely on the use of uranium, so the price of uranium may affect this company's bottom line. Also, if other companies try to build these products, the price of uranium could skyrocket. I've done videos on 3 uranium mining companies: Cameco, ticker CCJ, Uranium Energy Corp, ticker UEC, and Energy Fuels, ticker UUUU. If you're bullish on space exploration, but not comfortable with Rolls-Royce or similar stocks, you may be better off buying uranium stocks. We're going to look at the ticker that trades on the London Stock Exchange, so all the numbers in this video are in British pounds. Let's get started with the model. This is a mid-cap company, 8.9 billion market cap. They're trading at 1.07 pounds a share, and they have 8.4 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see their free cash flow is growing a lot from 2017 to 2019. Then they had a big negative in 2020. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was positive in 2017, negative after that. Revenue looked pretty good in 2017, 18, and 19, but dropped a lot in 2020. Of course, it dropped a lot due to COVID and less people traveling. So there was less demand for their aircraft engines. But a big part of their business comes from repair and maintenance contracts. So say for example in 2021, no new planes were being made, but a lot of people were traveling. Say there was a lot of planes already made, so they didn't need to make more. This company would make a ton of money on repairs. Because when they make an engine, their margins aren't that high, because it takes time, money, a lot of materials to make engines. But sometimes over the next 10 or 20 years, they have to repair those engines or maintain them. And it's very high margins. It's probably just something you should consider, and it's a good thing to know when you invest in a company like this. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And revenue minus cost of revenue gives you your gross profit. And they had really good gross profit in 2017, but it's been dropping ever since. It's now negative in 2020. Below that is operating expenses, and below that is operating income, which is negative every year except 2017. They also have a good amount of debt. They paid 180 million pounds of interest on their debt. And the bottom line of the income statement is their net income, which is negative every year except in 2017. A lot of investors, especially new investors, look at the income statement and see they had negative profits. So they think this company is headed towards bankruptcy. And that could be the case, but let's take a look at the statement of cash flows. The top line is operating cash flow. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. The income statement is a good tool to look at, but you have to realize there's a lot of accounting things going on. There are expenses and losses that are passed through onto the income statement. And some of these losses might have occurred years ago, but they're getting passed through in the current year. So the company may look like it's losing a lot of money, but when you look at the statement of cash flows, they're actually generating a lot of operating cash flow. Except of course in 2020, because sales were so low. But if you were to rely on just one thing, it shouldn't be net income, it should be operating cash flow. But the end goal of your due diligence is to look at everything, the statement of cash flows, the income statement, the balance sheet, and there's other reports too. When you put those all together, the puzzle starts to form and things make a lot more sense. And then of course you can make better investment decisions. Even if you're wrong, I've been wrong a lot, but I've learned a lot because I understood what I did wrong and I could use that information to go forward. But if I did something and I made a mistake on an investment, but I don't know why, I don't really learn anything. So a company like this has a lot of money in CapEx. Capital expenditures are investments in property, plant, and equipment. Because they have expensive equipment they need to use to make their products. Also, they buy warehouses to manufacture products. So they spend at least £1 billion a year in CapEx, up to £1.7 billion. Free cash flow is operating cash flow minus CapEx. They had positive free cash flow every year, except 2020. So they're not doing so bad. Their income statement looks really bad. And you can leave a comment, and if you want to know why their income statement looks so bad, we can talk more about it. But for the purpose of this video, I'm not going to get too deep into the income statement. They were paying a dividend in 2017, 18, and 19. But another way to reward shareholders is to buy back stock. They bought back over 200 million pounds of stock each year. When a company buys back stock, that decreases the shares outstanding, making your shares more valuable. They also issued debt and paid down debt. They issued and paid down a similar amount of debt in 2017, 18, and 19 combined. But of course in 2020 they had negative $4 billion of free cash flow, so they needed money from somewhere to fund their business. They issued $2 billion of capital stock and $5 billion of debt, but they paid down about $3 billion of debt. So they only added about $2 billion of debt that year. So I know it doesn't look good when they issue so much capital stock and so much debt, but sometimes things get difficult and you need money, especially during a time like COVID. But during COVID, there are companies that go bankrupt, a lot of companies. But the companies that survive, even if they just barely survived, but they survived, those companies that are going to be around are going to have all the customers. More customers than before, because now they get the customers of the bankrupt companies. Let's look at the capital structure. They have negative $5 billion of equity. That means their liabilities are $5 billion more than their assets, and they have $7 billion of debt, so they're 100% debt. Their net debt is $4 billion, so they have over £3 billion of cash on their balance sheet, and their WACC, their weighted average cost of capital, is 9.08%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's £30 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of £24 billion. We divide that by 8.4 billion shares. And we get a calculated stock price of £2.86. They're trading at £1.07, so they're trading at a 63% discount. It's a strong buy according to the model. You may think my future free cash flows are pretty aggressive. I do think it's possible they'll have positive free cash flow in 2021, but I made it negative to be conservative. You can see from 2017 to 2019, they grew their free cash flow a lot, over 900 million pounds. So if COVID didn't happen, I'm pretty confident they would have been well over £1 billion in 2020. But COVID did happen. And I think by 2022, they'll get back to where they were in 2019 and then keep growing from there. I don't think it's too aggressive of an estimate. Of course, I feel bullish on this company because I think they make important products and they have a great business. There's a lot of people out there that are bearish on this company. They think they're going to go out of business, they have too much debt. Everybody has their own opinion. Simply Wall Street is a little higher than me. They're at £3.19. So they're saying the stock is 67% undervalued. This is the stock price since it started trading. And these numbers are in pence. 100 pence in a pound. So if you want to divide these numbers by 100 to get the actual stock price. So you can see they were trading at close to 400 pence a few years ago. But the stock is pretty low. It's almost at its lowest point of all time. This is where the stock has been trading the past year. It got down to 35 pence. I wasn't following this stock too closely, but if I saw it dip below 50 pence, I would have jumped on it. Even at 106 pence, I still think it's a great deal. And they have a pretty high beta, 1.88, so the stock moves about 2 times the market. It's a bit volatile. The stock has gone up only 7% in the past 52 weeks, while the S&P 500 went up 40%. So obviously you could have done a lot better by investing in other companies in the market. Not just in the market, but investing in other companies in this industry. So it's really hard to time the market, but I think this stock should explode one day. Their 52-week low was 35 pence. Their 52-week high was 137 pence. And the stock is trading at the 50-day and 200-day moving average. This is a really liquid stock. 35 to 40 million shares are traded each day. This is on the London Stock Exchange. But on the pink sheets in the US, 5 million shares are traded each day. That's a lot of activity for a stock that trades OTC. Most of the shares outstanding are on float, and 65% of the shares are held by institutions. Analysts are expecting their earnings to grow 88%, so they're bullish on their earnings, but they're not that bullish on their revenue growth, only 5%, which is similar to its industry and the market. In the past 5 years, their annual earnings decreased 24%, whilst industry and the market increased. In the past year, their earnings really suffered, down 137%. Surprisingly, its industry is up 14% and the market's flat. If you invested $10,000 into this company 10 years ago, you'd have only $1,800 today. That's an 81% loss. The biggest shareholder is Causeway at 9.5%. They own 787 million shares. Then Capital Research, then BlackRock owns 500 million shares, MFS Research, and Vanguard. Let's look at their financial ratios. They have negative net income, so we can't look at the PE. Their price to sales is really good at 0.8. That's much better than a market median and average. When a price to sales ratio is below 1, that means their annual revenue is higher than their market cap. If you're a big fan of the price to sales ratio, then you'll love this stock. We can't look at the price to book because they have negative equity. Their current ratio is a little above 1, so they can cover their current liabilities with their current assets. And their current assets are $3.3 billion of cash and $3.7 billion of inventory. So they do appear to be undercapitalized. They had negative $4 billion of free cash flow in 2020 and $691 million of working capital. So they're short $3.3 billion. But I'm pretty confident their free cash flow will be much better than negative $4 billion. I think it might be positive, but if it's not positive, a lot better than negative $4 billion. So if they do have negative free cash flow again, they may need to take on more debt to fund their operations. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 19 companies in the same industry as Rolls-Royce. And if Rolls has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They have one of the best price to sales ratios of anybody in this industry. And they're worse than everything else. So it may look really terrible that they have negative equity, so we can't look at the price to book, and they're 100% debt. People get really focused on equity, and they think if you have negative equity, the company isn't worth anything. The main thing you want to focus on is cash flow. If a company has lots of equity, meaning lots of assets, the only way that can benefit you is if the company goes bankrupt, sell off their assets, and give it to their investors. But the purpose of any company is not to sell its assets or grow its asset base, it's to make a profit and generate cash flow. So as long as a company is generating cash flow, then things are fine. Of course, if interest rates went up a lot, companies with a lot of debt may be in trouble because they would have to refinance their debt at a higher interest rate. But as long as the interest rates are low, having a lot of debt shouldn't affect your business too much, as long as you can cover the interest payments on your debt and still have excess money to pay out as dividends or to grow your business, which they did prior to 2020. So to summarize, I have them trading at a 61% discount, but this stock seems to be at a really great value. They have such an iconic brand, and people don't realize the company started as an engineering company. People only think about Rolls-Royce as cars, because cars are really visible, and you could see people driving cars down the road. But aircraft engines, you could fly on a plane hundreds of times and you have no idea Rolls-Royce made the engine. You might know Boeing or Airbus, but you don't know much about the engine. They do play a really important role in aircraft engine and other propulsion devices. So that's why I'm bullish on this stock. I rank their free cash flow as 1 out of 10, their revenue 4 out of 10, and their ratio is 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.